Alright, Kalimera Anthropos! Good morning, everybody. Welcome to our Economic, all about economics and finance. And okay, so today we are doing a live streaming, hopefully, if it works. And I've decided to make an important update about the stock market because it's really, really, really fishy. Okay, so I know that every day there is somebody who say, "Oh, it's gonna crash, it's gonna crash, it's gonna crash." Every day there is somebody who is predicting a stock market crash. So I'm not different from anybody else, and we will go together. We will see together some very simple charts and technical indicators. I will show you a little bit of my own work with some other modeling, more complicated. But anyway, why I'm doing this live? Because I'm concerned that there is a build-up of a truly dangerous financial asset bubble, okay? And it's evident also in all sorts of mass media, which has been going on for decades now. Basically they're all lying, and it's the information. It's manipulated, and basically the media, they are told not to tell the truth to the public. But I mean, any ordinary person with a bit of brain can understand when somebody is saying something that it's reasonably rationale, or they are outright lying with a straight face because they need to line more money into their own pockets. So it is evident by any chart of any stock market. Okay, we know that an equity index, it's a basket of list companies, and so by doing the technical screening of the charts, of the price actions of the index, we can have some sort of surface, scratching the surface of the market, right? But I mean, here we have the chart of the Russell 3000, which is in the jargon, in the parlay of the market, it's the wider index, which is representative of the wider stock market, because the Russell 3000, it's a broader index of 3000 listed companies. So it's there is basically the whole a good chunk of the public list companies in the Russell 3000, compared with the S&P 500, which comprises only 500 companies. The Russell 3000 is a better gauge of the market overall, on a surface level, to understand what is the state of affairs in the moment. And so you can see, we can see together here how the trend, the price action of the index has been very extended on the upside. We are at an historical all-time high after all-time high. So prices of financial assets, they are creeping higher and higher and higher, which is quite dangerous, because there are two sides of the same thing, right? If you are a portfolio investor, okay, you see the share price of your portfolio, of the overall net asset value of the portfolio, it's going up, it's increasing in value, and you feel very wealthy on paper. The problem is that on the other side, the higher are the prices of financial asset, the less liquid these become, okay? Because for a stock or any financial asset to go up, you always need the marginal buyer at a higher price. I need the buyer here, and then this buyer needs another buyer here. Okay, it's the classical Ponzi scheme. You always need somebody who's gonna pay a higher price. When this chain breaks up, the whole Ponzi scheme collapses. So the whole American financial economic construct, it's total bollocks. Okay, it's some of the worst social, economic, and financial systems that have ever been conceived in the history of mankind. It's abysmal. It's something that I don't know what word I can use, but it's horrible, honestly. So you see how the Russell 3000, it's going higher and higher and higher and higher. And again, the higher is the price of any financial asset, the less liquid these are. It's not only a technical definition of credit worthiness of a financial instrument. Okay, something which is rated AAA, it's supposed to be highly liquid. Okay, the same of the mortgage-backed securities, which were AAA, or Bear Stearns, which were AAA, or if you take Goldman Sachs, which is a very reputable investment bank, which is basically a bankrupt. So the higher is the price of the financial asset, the less liquid these are, because by the minute somebody starts to sell, okay, they want to realize the gain that they have on paper, then the price starts to drop way more, way faster than it took time over time and money in to go up, to inflate. Okay, the crash happens very fast, all of a sudden. So all the gains that you are sitting on in your portfolio, they are on paper. It's an inflated value, which is not the real value of the financial asset. That's why I'm saying there is a risk, evident risk, of a financial asset bubble, which can turn into a massive crash and wealth destruction. Okay, which I don't really mind. So you also hear this mac and cheese indicator. You see how it's a very high over both level, and you have this some sort of kink on the top. It's like a hook or something, so the curve is turning. Okay, so anytime you see this curve turning, people start to panic, because they don't know if there's gonna be somebody who's gonna come in and buy, because these prices, they are really high. If you get in at these levels, you are very likely to take a secular risk. So if I change the indicator, because the MACD it's more complicated to read, but if we take the classical RSI, it's above 70. It's not near 80, but you can see that it's in over both level. That does not mean per se, does not mean anything special, but it can be over both for a long time. What that means, that there is a lot of strength, buyer strength into the market. But again, the same concept. The higher are the prices of financial assets, the more risky they are, the less liquid they become, the more it's way more expensive to get into the market, the marginal buyer at a higher price, and the Ponzi scheme is going to collapse one way or the other. Now, Something which is very funny is the Nikkei 225, which is gone full tonto. The Nikkei 225, it's gone totally full tonto, right? This is unbelievable, right? So, by any stretch of any imagination, if you take any pinko panko from the street and you show them this kind of thing, they would say, okay, what the heck is this? This is not normal. These are not normal price discovery in markets where there is a rational price discovery, bid and ask, and you say, okay, no, the prices, they only go up and up and up and up and up. So it's evident by the behavior of investors, which are reckless, and I would say they are criminal, that there is a criminal speculation going on in markets, which has been fueled by a huge chunk of that bad debt that has been issued because of this speculative mania of artificial intelligence. You don't need any AI to see how the Japanese stock market, it's gone full tonto, okay? That's not a normal price action discovery. I mean, my chart doesn't want to cooperate, and I'm sorry about that. But anyway, this has skyrocketed. If we want to measure in percentages, okay, from the all-time high here, which was the older one in 1990 something, 1992, whenever it was. Okay, sorry, I think there is a bit of buffering into the system. It's a 49% over and above the historical all-time high, which is here. You see this MACD, it's 4,972. I've never seen numbers like that. I mean, I don't have this huge experience in markets. I'm not a veteran of the markets and all that jargon, okay? Because basically this is financial markets. They are a fake economic system. It's a fraud, basically. It's just doing money supply and hiding the hyperinflated money supply in these papers, these piece of papers which are called shares, okay? And then you create all sorts of speculation in a fake economy because you're not producing anything. You are exchanging money for other pieces of papers which are financial securities. Okay, so it's a whole Ponzi scheme. Now, this indicator was only by the naked eye, that was here. That was the historical Japanese market speculation, and you can see how the indicator has way moved above that level. So it's really, really extreme. We are at some extreme levels of financial assets inflation. Okay, because central banks, of course, they bother about the cost of living of people, and so they are concerned about what are the wages of ordinary people, and then they are totally eyes shut with financial assets inflation. That's why the system is made to screw up the whole population, and it's unjust, it's unfair, it's the opposite of any rational economic system, which it's based on the most rational and efficient allocation of resources which are limited. Okay, we live on a planet which has limited natural resources, We cannot achieve exponential or infinite growth with finite resources. Okay, if I have only a certain amount of hydrocarbons, I cannot have an infinite growth in oil production, plastic, or gasoline, etc., etc., etc. I need to find some other methods to generate energy. Okay, it's as simple as primary school. It's you must be really dumb stupid to ignore this thing. Now, apart from that, and the Japanese, they are really cool. They have some important technology, which is ionized sodium batteries, which means that they actually use salt water to to manufacture batteries which are for electric vehicles. So they use the ocean water, okay, the sea water, the classical saline, I don't know, salt water solution, or whatever you have in the normal batteries that you have in your car, which has a combustion engine. You have that battery, so they use the same thing, salt water, okay, and they build larger accumulation batteries so that you can power on your EV, and you don't need to take kids and screw them in some cobalt and lithium mines in Congo. Okay, so that's why the Japanese, they are very ethical in their life, in their work, and they have some really cool technology. But the stock market is gone AY. This is all speculation. Also, it's all part of the speculation, like the election cycle, so forth and so on. So, apart from that, you can see that the Nikkei 225, its full tonto, it's almost 50% above its historical all-time high, which was plus 30 years ago. And of course, if you go and see each and every company which is in the Nikkei 225, you will easily find that these share price, they are very inflated. Prices, they are actually very inflated. They do not reflect the real concrete economic value or the real cash flow that these companies generate, so forth and so on. But we can go across any market. Okay, here we have the Nasdaq 100. You can see how parabolic, okay, hyperbolic this is getting. And the Nasdaq 100, the technology stock index, they are the first that they are giving this, showing this sign of curvature in the top of the market. And you can see how the MACD here, the indicator here, it's spelling danger, because but anytime these things takes a turn, then it becomes the flash down, it's dangerous, and people, the ordinary people, they lose a lot of money, because the big speculators, okay, they all work together. They take the margin, they take the no ordinary idiot who pretends to save in stocks and shares. They take their money, say, oh, we park this money in this fund, this, that, and the other. I think that there is a bit of buffering. Anyway, I will keep going on. So, the big funds, they sell before, and they go to cash before ordinary investors. Because if you are a small investor, you are trapped. You are a client of these big funds. So basically they take your money literally, okay? Because then they dump shares, they keep the cash, and you are out of pocket. You're probably in negative equity. That negative equity is the money that investment funds, your I don't know, your wealth consultant, wealth management consultant, so forth and so on, is the money that they pocket. So that's a real risk. People that they will see their saving depleted. Their portfolio will be in negative equity, and their wealth management consultants, they will also, it's a blip in the market, this, that, and the other, don't worry, there's nothing to worry about, etc., etc., etc. And you know how financial crises end. People, they lose money, they lose savings, they lose everything. Then there is an economic crisis, and then speculators, they walk away with millions, if not billions. And so here, it's what I have noticed is that the technology, the tech index, which is the Nasdaq 100 and the Nasdaq Composite, they are already forward stepping vis-a-vis here what is the Russell 2000 or the this is the stock 600, the Russell 3000. You see they are already 1 or 2 steps forward. So they are a sort of leading indicators of where the AI mania speculation it's going. So for what I can see, the seasonality pattern of 2026 is not the same of 2025. What do I mean with this? What do I mean is that usually we expect to have a correction in the market in the first 3 or 4 months. You have a drawdown which is taking profits from the rally, the bull rally in the Christmas period. People, they take profit, they pay taxes, so they take profit or they draw down their portfolio, I don't know. They should sort of pay taxes by April, and then you start the new asset allocation running up to the end of the year. And so that is the typical cyclicality on a 12-month basis. Now, here we are having some sort of nipping downwards of the Nasdaq, so the whole tech-heavy stocks. So these are interesting signals of how institutional investors, they are already stepping forward in dumping down the tech sector, which is very, very interesting. So, but the cyclicality this year, it can be a little bit different because we are already between February and March. Still there hasn't been a sizable 10, 15, 20% correction into the market. So I would expect that a more sizable throwdown will come into place between Q2 and Q3 in the back half of the year. And because probably I don't know, I do not see the future, but the rationale is that the cyclicality, the trend cyclicality or the cyclicality signals into the market, they are different from 2025, and I will show you my own modeling on how and why I'm inferring this thing. So we can see here that the Nasdaq 100, these are monthly candle bars, okay? So this is February, so we are having a tiny repricing because there is this exuberant mania of artificial intelligence. It's about 7 or 8% from the all-time high top, but we are talking about, what is that, 26,000 and more. Like I mean, if we see the Dow Jones, it's way past 50,000. So these are levels which are incomprehensible, which are not in any way correlated to the economy. Because if you go on the ground in the United States, you have quasi-civil war. The stock market is creeps and goes higher and higher and higher. So there is no real connection between the speculation in financial assets and the real economy. And so why there is this huge speculation in financial assets? It is exactly because the real economy is not profitable that much anymore. So the only source of extraordinary profits is it's stock market speculation, because where we are in the business cycle, there is no point in doing some investment in any industry or manufacturing or producing anything. There is no point, because all the macroeconomic indicators, they make it very difficult for any entrepreneur to open a business and to run it sustainably, because we are in a high cost environment, slow growth, and there is a lot of instability, social, economic, and the biggest problem is the political and geopolitical instability, which make any entrepreneur prefer to have liquidity rather than invest into real stuff. Okay, I want to build a plant to manufacture tires, okay, for cars. I'm not gonna do that because there is too much political and geopolitical instability, which then cripples through the customer, my potential customer behavior, or any other industry which can find itself, like car manufacturers, they can find itself in a downturn, an economic downturn. So if I am small producers of tires, who is gonna buy my tires? If the car manufacturer, it's shrinking down its production because there is too much instability. So the only point where you can find gains without doing anything is speculating in the stock market. And this is the worst behavior in time that a society can have, because if we think back about 1929, 1930, then you realize what are going to be the consequences of such a establishment behavior. So you would say, okay, no, don't worry. And then it's always poor people that they end up in the trenches and they fight each other. This is true, but I don't think that if you are somewhere in any government building, you'll be safe. That's not a guarantee. Okay, so as I said, the Nasdaq 100, it's one or two steps forward compared to the other markets. Now, another thing, jumping from north to south, if we go and see this, which is very interesting, this is the Argentinian stock market. So that's really a strange shape or pattern, but we are what? The top was 3 million and something. 3,200,000, so forth, and so on. But you can see how hyperbolic this market is. I mean, only in 2022, this market was worth 91 million points. I don't know how they measured this. What is 91 million points? Oh, no, sorry about that. 88,000. Yeah, if I read it properly. Now it's 3 million. So we are here, July 2022. The Merval index, which is the Argentinian stock market, was 76,671. And then here in 2 or 3 years time, we are at 3 million, from 76,000 to 3 million. And no wonder there is this huge red bar down here. So there is humongous speculation anywhere, really, literally anywhere, in the most unthinkable places or corners in the market. Even Argentinian equities, they are pie. This is pie in the sky. This is really it's not normal. It's definitely not normal, because also you have Argentinian people who are rioting, and the government has passed the law that you must work at least 12 hours, 14 hours a day, no day off, nothing. Is actual modern slavery. And so we can see the RSI, which is not really indicative, but it's giving some a downtrend signal that of course the RSI is not gonna come up and say, okay, it's a stock market crash. But anyway, if we read the numbers here, July or August 2022, the market here was 92,000. Here we were in January 2022, okay, 67,000. Now we are fast forward in January or December, January, March 2025, or no, February 2026, or January 2026, 3 million. I mean, this is unconscionable, the way this market speculation has gone up. And then, when Milley went to the United States and said, okay, I need a 5 billion bailout, now we know that those money they've gone into financial asset speculation, basically. So these are really, really dangerous things. Think of a country like Argentina, which already is in turmoil, and the stock market speculation is at these levels. When these things comes crashing down, what are going to be the consequences? And the social situation, socio-economic situation, it's already really unstable. And that's really, it's reckless. It's beyond reckless. It's to me, this is criminal. Okay, so but unfortunately, I can do very little in making financial speculation accountable for their alleged out of hand not really legal activity in financial market, because this kind of this is really like a pump and dump scheme. So you're pumping up this Argentinian index and then it comes crashing down. But who profited from that? Then you need some levels of data which are not readily available on TradingView. But I mean, even the most dumb donkey would it's able to understand that there is something which is not in line, which is not really ethically proper. There is something which is not normal, honestly. So if we open the chart of any index, this is the FTSE 100 in Britain, and it's skyrocketing high, so it's full-on speculation. The DAX, full-on speculation. The that's the Italy stock market. I'll have to load it again, so there will be some buffering coming up. I'm sorry about that. Okay, you can see how also the Italian stock market is very close to the historical all-time high, and Italy full 2025 gross domestic product, full GDP, it's 0.7, 0.8%. It's less than 1%. So for an economy that in an aggregate of 50, 60 million people, it's growing by less than 1% per year, and then you have the stock market at the all-time high. There is something which is clearly wrong in this thing, and it's gonna end very, very badly, and I'm sure of that. This is not going to end well, because this is clearly, again, financial asset speculation, which does not reflect at all the macroeconomic performance, the value-added creation of an entire national economy. Okay, Italy grows at less than 1% per year, and wages they have been stagnant for decades. I don't know from where there is this inflation in financial assets. What is the reason? Where are the cash flow, the companies, the earnings of these large companies? There are few of them which are good. It can be Unicredit, it can be Ferrari, but all the other stuff, like Intesa Sanpaolo, perhaps is a very good bank, it's very well managed. But if you go and check the other stuff, I don't see that they have these stellar cash flow profitability, or they pay so large obnoxious dividends that you want to pay multiples and multiples and multiples of the cash flow. So it's a financial assets equity speculation. It has been going on for quite some time, and I don't have a timing for a crash of any, but the consequence, there is no need that I'm going to say what is the consequence. It is evident what is going to be the aftermath of having a run-up of hyper-inflated financial assets. And then it's going to be painful. I don't know what central banks can do. So if you have a bank like Goldman Sachs, which has like 300, I don't know, 100, 200, it has hundreds of trillions, okay, in financial derivatives off the book, and they have some sort of 1, 2, or 3 trillion in assets. You can understand, but the net liquidity of the bank, it's a few hundred billion. you can understand how out of balance is a large financial institution, a large investment bank as Goldman Sachs. They run a derivatives book which is in the hundreds of trillions of dollars, but their net equity value is between 200-300 billion for I don't know, don't have the exact numbers, but I'm not speculating. If you take the data of the largest investment banks, these banks, they run hundreds of trillions of dollars in derivatives which are off their balance sheet, but their net equity value, it's a fraction of the speculation that there is in the derivatives market. And so those are, to me, they are bankrupt investment banks. And there is no wonder that there is the former Federal Reserve Kaplan, which works at Goldman Sachs. Why? Because he's a smart guy? Sure is. But because he keeps an eye on the bank, because they know that Goldman Sachs, apart from the facade of being such a wonderful thing, it's a toxic financial investment banking operation. So as the other banks like Citigroup or Deutsche Bank, Societe Generale, etc., etc., etc. And I'm not scared to name names because at least I can name names, because these people, they never end up in jail where they should be if and when a financial crash happens. So okay, so after the mumbling and the rambling, let's do some other Fibonacci retracement. Okay, so let's take our favorite Nasdaq 100. No, this is not the Nasdaq Composite. Okay, so because we are arguing of I am arguing of a technology financial asset bubble. Let's say we take this point here as a support. Let's keep it simple. And from the top we are the Nasdaq, the composite is already 7 or 8% down, repricing. Okay, so here we are at 16%. The value of the index would be around 20,000, okay, which is reasonable. So the boundary term, it's the 20,000 area, which is because the Americans, they like round numbers. Okay, so if it's the 20,000, it's the benchmark between 19 and 20. So it's the step between one decimal and the other, 1 and the 2 decimals. Okay, so that's the reasonable or what can be expected for equities to reprice, discount their inflated share price or the inflated overall index value. Okay, so the composite would eventually has stopped at the 24,000 and change historical all-time high, and it can reprice its value by 15 or 16%, approaching the 20,000. Why? Because it's the I would rather say the psychology or the forma mentis of speculators in American in Wall Street, because they will want to they will want to see if speculators that will go in and buy at 20,000. Okay, because 20,000 is this famous round number or is the area where you can say, okay, if you buy at 20,000, that means that it's a confirmation that the market, the Nasdaq composite, it's worth more than 20,000 points, okay, or $20,000 per contract. And so what that means that there will be somebody that will buy at 20,500, 21,000, and so the speculative idea, what it is, it's quite simple for my humble understanding or interpretation. If I can, where is the, okay, so here we have this thing, it costs $24,000, yeah, one contract course to, let me use the highlighter. This thing costs $24,000, 24K. So now, because it's an historical very high price, the same speculative activity in market can be perhaps the same investment banks, the large players, say, okay, 20K perhaps is very, very high value, I want to discount it a little bit. So they start to sell because they want to realize some gains, and the rationale it's here because here is 20K, and their rationale is that, okay, if there is people who goes in and buys at 20K, that means that they will be they will agree to pay 21K, 22K, 23K, 24K. So it means that they want to validate this all-time high in this manner, okay, and then go up again, jack it up again. So that's perhaps the more speculative and facade or speculative side angle of this thing. Something that costs 24,000 per contract, and perhaps it's way too much for speculation. There are no marginal buyers at 25,000 or 24,000 and change. So you see that they start to sell. Perhaps they sell futures because they think that in the future the value of the index it's lower than the value of cash. Now I don't have the futures curve. I can find the futures curve, so perhaps it's more informative to have the futures so that we can understand. Give me a minute. So I'm trying to get on with the website that shows us the futures market, because I'm not a speculator, so I don't go on about particular things. I have to find it from the bar chart website. Just one second. Futures. Okay, index futures. Page is loading, and there's going to be a lot of buffering for sure. Okay, so here we have the actual prices. Okay, of course the futures, the value it's higher because they are discounting the future value by the prevalent interest rate that there is in the market. So the futures curve, it's higher. You can see how the futures market, this is the Nasdaq 100 E-mini, so they are pricing way above 24,000. But the actual, although these ones, they are pretty much in the green, they are positive now. I don't really mind. Okay, but the cash index, okay, but that's the Nasdaq 100 on the Nasdaq Composite. Okay, so here we have the last close of the cash index, it's 24,900. Okay, yeah, the latest cash it's 24,700, and the futures curve, it seems to be upward. Okay, so the market is discounting higher future value of the index. That would be 25,000 per contract, 26, 28, 29,000 per contract. But the price action in the cash market, as I said, is a step forward, and perhaps it's way too expensive for speculators to pay these higher prices, because this all-time high here, cash 26,200, it would be equal to buying a December 2027 future contract. So you are placing a lot of faith, which is 1 year forward, 2 year forward, because the whole 2026 and the whole 2027, that the market will be, the price of the market will be higher in 2 years' time. So there is too much, not too much, it's a leap of faith to presume that in 24 months' time the value of the Nasdaq 100 would be way higher than 26,337 points. So that's why we were looking at the Nasdaq Composite. We can see the Nasdaq 100. It's pretty much the same irrationality. Okay, so the level here we are checking out at 22,000. That would be the level of interest for speculation. And if we measure from the top, okay, that would be around 16% repricing. And so the song remained the same, okay, because they say, okay, I'm paying 26k per contract here. Here I'm going to pay 22k, and the market will in the market, speculators will find out if there are buyers for 22k or if still it's way too expensive. And so there will be more sellers than buyers, and the price of the value in points of the index still will have to be discounted. Okay, so that's the price discovery between bid and ask. Of course, the index, it's exchanged in futures contract. You have an upward slope of the futures curve. In the Nasdaq 100, there are 100 listed companies which have some humongous price to earning ratio. So here this is really it's really inflated. The value of this market, it's absolutely packed up and inflated at humongous levels. It's really hyperbolic, and it's not hyperbolic to be concerned that this thing can basically crash heavily, and the aftermath of such a financial crash, they are going to be really bad, really bad. So again, my concern is that there is a financial asset, and now it's even too late. Okay, the problem is not that there is a financial asset bubble. The problem is that it is too late to bring under control this financial asset bubble. The only possible outcome is a stock market crash. That is the nuts, the nucleum of the of the issue, is that there is no way any central bank can engineer a orderly or a calm and without consequences deleveraging of a financial asset bubble, which has been building up since for more than a decade. Okay, with the sequence of all quantitative easing and the speculative activity of investment banks. So this thing has been building up for well more than a decade, and there is no way you can claw it back without, in a normal fashion, in a normal way. So the only possible outcome of such a financial asset bubble, it's a crash. There is no other option. So that's my concern, and I'm sure that it is not my own personal concern, but probably the people who are in the business, who manage funds, who have actively pumped up this Ponzi scheme. They know that sooner or later this will come to an end. And so, but there is no way you can control the coming avalanche. So, in the beginning of the live, I said that the cyclicality this year, it's a bit different. Okay, so let's go and see what do we have here. I could go on for hours and hours and hours about the volatility, the value at risk, all the risk management measures of the indices, whether it is the European markets or the American stock market. I could go on and on and on and on and on. Let's see okay, so that's the VIX term structure that was 1 week ago or 10 days ago. What was the signal of the VIX term structure? Okay, these are the Fourier transform. Okay, so that's what I'm looking for. Okay, so we have as you can see, my model indicates that was at the 9th of February, the last time I updated the thing. So my model indicates that there is the VIX term structure, it's in a contango, so they are pricing slightly higher VIX futures contract with respect to cash volatility index. Now, the volatility index, it's important to... I think there is a bit of buffering. So the volatility index is not only a gauge of volatility in the market, but that's very important to understand. The volatility index, it's a very complicated, first and foremost, hedge instrument, because there are systematical trades, systematical methods, quantitative methods, which, for example, in a uptrend market, the systematical quantitative strategy is to short the VIX and buy the market, basically. So the VIX index, the volatility index in itself, it's not only a measure of the volatility in markets. It's an hedge instrument. It's a different thing. It's a different thing. If you see it from another angle, you understand that the volatility index is primarily utilized for hedging strategies. There are quantitative financial engineering methods that, as I said, if the market is going up, you buy the S&P 500 and you sell the VIX, the volatility index. What you do, perhaps you can sell calls, you can use the option side, which makes it more complicated and more leveraged, because options, they are derivatives, so there is even more leverage. And so you can sell call options of the VIX cash, and you can buy S&P calls, or you can buy you can go long the index. But there are other quantitative strategies, for example, which play around the VIX term structure. So I don't know now, I don't remember exactly, but there are strategies in which you can sell. I don't want to talk about something which I don't know, okay? But the main concept is that the volatility index is not only a measure of the volatility of the market, okay? Because the volatility of the market, you find it in the market itself. What do I mean with that? You basically take the daily returns of any index, and you measure the rolling standard deviation, or you can measure the Garch model. Okay, so that will tell you exactly what is the volatility, the historical volatility of the DAX. So that is the method by which you can empirically see the volatility of that index, of that stock market. Okay, so if you want to know the volatility of the DAX, you don't go and look at the VIX. You want to know what is the 7-day DAX standard deviation, the 21 days DAX standard deviation. You want to know what is the highest fit Garch model, which is the conditional volatility model, which is basically is the volatility that takes into the equation the time component. Okay, it's not a static measure, because the standard deviation is a number. The conditional volatility, it spans all through the time of data. So there is the time component, and you can measure the idiosyncratic parameters with a conditional volatility model. And you can see the daily return, the distribution of the daily returns, what are the fat tails, where is the kurtosis, so the out of whack basically days when you move in way above the 3 standard deviation measure. So the volatility of the market, you do it by by calculating the standard deviation of the daily returns. The VIX does not really measures the volatility of the market. The volatility index is utilized as an hedge instrument for what the market does. The market goes up, I'm going to sell the VIX. So there are quantitative hedging strategies which bring two things together, okay, which eventually they are inversely correlated. If the market goes up, the VIX goes down, so I sell the VIX, I buy the market. If the market goes down, I sell the market and I buy the VIX. So that's the basic functioning which I do not need to explain, but it's important to clarify that you can see here the volatility of an index, you measure it by knowing the standard deviation of the daily returns of that market. The volatility index, or the VIX, or the Chicago board volatility index, it does not strictly measure the volatility of the market, but it's an hedging instrument. It's another thing. Okay, so at least that's my humble interpretation, but I'm sure that at least in part it works in this way. So that the volatility index, it's an instrument that is built to hedge the market, the volatility of the wider market. But it does not measure the volatility of the market, because you need to know what is the standard deviation of that market in that moment, or the conditional volatility. So here, for example, we have some charts and we put together the TD mark sequential indicator. So I managed to graphically see at which point of the cycle what signal I do get from the daily returns, and you can see here bull market. All the European index, they all signal bull market, rather than the Copenhagen index, not for the Danish, which I love, and the VIX volatility index, which is transition, which I don't know what that means, where it's a cyclical transitioning from peak to trough, from trough to peak. That's what basically means. So we can see here the signal that we have of the daily returns of the DAX. We have the last signal that we have a cycle trough, so we can expect reasonably to encounter a cyclical peak. That's why I said the cyclical peak of the market this year is not happening at the beginning of 2026, but it's cyclically going to materialize a bit later during the year. The same is for the CAC 40, and the FTSE 100. Already I have that was 10 days ago, so I don't know how reliable is this, but the latest thing that we have is cyclical peak. But if I go and see the chart here, I go and see the chart, mate. It's only going higher and higher and higher. So these are two different things, because this is the monthly chart. Okay, let me close this thing. If we go for the, okay, so the daily chart still is going up. Okay, no wonder. Okay, so we are past the peak. It was a very short lived cyclical peak, and yeah, its market is going up. So this eventually would justify the fact that the seasonal cyclical peak or top of the market, which is expected in the first quarter, it will not eventually materialize in the first quarter, but it can happen in the second and the third quarter or the back half of the year. Okay, so there is a different cyclicality signal in the market, okay, which is not unusual. It depends on the the cyclicality signal. So if you transform the price function in a sine and cosine function, eventually you transform a stochastic differential equation in a Fourier series. Yeah, that's what technically I have been doing for quite some time. So the Nelson-Siegel, so it's a model that fits the VIX curve. We can see here what is the slope, the curvature of the parameter. This is very interesting. It's used for the yield curve. Okay, the VIX term structure trading signal that was 1 week ago, you can see there is a green triangle, so that means that you should be buying the VIX, because the model tells me, okay, in the coming months, the 3, 4, 5, 6 months VIX futures, it's upward sloping, and it means that if you buy the VIX now, the future, the value of your cash contract today will eventually converge to the higher price of the future contracts, and so you will make a capital gain. So that's why it comes up with the green triangle. We say, okay, you have to buy the VIX index now for a hedging strategy reason, because the cash value of the index will converge upward, will gain value, and it will converge. It's very simple. I'm wasting words. So you buy here at 16 or 18, whatsoever is the value, 17 and change, because you know that you buy here, you know that the cash value will converge to these levels eventually, to 18, 20, okay? And so it means that the cash value will narrow the spread with the future contracts, and when you buy the front end of the curve, you make a capital gain. That's it. That's speculation. And you're edging. Even if the market is going up, okay, but the quantitative hedging strategy with the volatility index do involve all sorts of very difficult speculation, and these trades, they are treacherous, okay, because the volatility index moves way sharply, and then the stock market. So these are very complicated hedging strategies. So I want to jump on this. I want to see just only, because I don't have time to go through that. Where is this? Bear with me 1 second. I'm not going to hold you for a long time. What I can say is that I have a lot of quality data. Okay, so we start to see. Okay, so the latest Fourier forecast that I have updated through my models, which by no means are perfect, show me what they show me are this. Okay, so these are the tables, and eventually this is a peak in September 2025. So the trough of the market eventually should be by August, September 2026. The trough of the market will be in August 2026. So what that means is that there is no sharp immediate correction, but it's what I see here is the you see here normalized cycle position. So it's way complicated, but basically it does not tell me there is the result is that there is no trough in March or April 2026, but the trough, the cyclical trough of the market, it comes out to be August 2026. That's why the downward repricing of the market is not going to be a one-stop shop in the first quarter. It's probably a more gradual cyclical, not correction, but repricing. And because the cyclical position, it reflects the price action which goes up and down, but the signal is slightly different. So the trough, for example, for the DAX, it comes out to be in August, the peak September, so it's a small cyclicality. And then you can see here how, for example, as an example, you have a trough in you will have theoretically a trough in January 2027, so the cyclicality eventually aligns with the typical cyclicality or seasonality of what the investor parlance, a parlay. So you have a trough at the beginning of the year, January 2027. You have a peak in May or June, although May is selling May, go away, it doesn't matter. And then you have another trough in September, which can be typical, and you can see here going forward, you're peaking, the cyclical position of the market will be peaking in February 2028, so you have the typical seasonality, okay, and then you will be a trough in August 2028. So for 2026, from the data that I have on my own work, and you have to place you have to take it with a pinch of salt. Yeah? Do your own research. But what do I observe by my own thing is that the cyclicality, the cyclical position of the market, it's not coming to a trough in the first quarter of the year. But here for the DAX, the trough is August 2026. And the cyclical position is going to be the same, and the real trough eventually could be January 2027. And then you can see here that the curve turns and you have an upward cyclical trend in May 2027. So, but eventually you can see July 2029 there's a peak, and then you have the cyclical. What is important, you have to check also, double check the y-axis. You see that the normal cycle is negative and negative and negative. So that means that it's a rotation to the downside. Okay, and we have peak July 2029. The peak of the market the past century was the first sell-off. It happened between July and August 1929. Okay, so that's the table, and then you have a description and say the dominant cyclical period, it lasts 18 years and change. So there is predicted peaks and troughs of 5 and 6. The average cyclical cycle length is of 10-11 months. Okay, forecast range is the cyclical position, and then the 95% confidence interval, and you have the value that you can add or subtract to the forecast range. Now there is a okay, so this is very, very precise. Okay, you see what is 7 months ahead, etc., etc. It's really precise. Okay, so the same is here. FCH, I believe this is the French market. So again, the dynamic is the same. Trough September 2026. The problem is that when I see the peak in August 2029 and then the huge crash. So the cyclical position of the market for 2026 is not the typical cyclical position with a trough, with a bottom between February, March, or April. Okay, I think the bottom this year will be around Q2, Q3. Okay, now here we have September 2026, that's the French market, and then it goes up again. You have a peak 12 months later, so the average length it's still between 10, 11, 12 months. Okay, so the amplitude of the cycle, the cyclicality, is pretty much similar. Okay, so it means that markets they have cyclical periodic functions which are more or less synchronized, which is the amplitude of the curve. They are pretty much the same. It depends on which cycle period you are considering, because there are 5 or 10 years. You can see a dominant period 18 years. There is shorter periods or larger period, depends of what kind of market signal in that terms. So here the VIX is opposite, is going to peak in July 2026. So the top of volatility index eventually will materialize in Q3. Okay, so this is not the typical here when you have the top of the volatility in the first quarter. Okay, that's the IBEX. So the Spanish index is going to bottom in September, and okay, so you can see the cyclicality. To keep it simple, okay, also the FTSE 100, you have the bottom of the market in September 2026. So it's for the minute, the market, the equities, they will keep going higher, but the cyclical position, it will follow this path. Okay, and eventually the price will start to be discounted. You will have a sell-off basically, and the bottom of the sell-off I do expect by my own models to be in Q3. That's what my work tells me. Now the stocks, Euro Stocks 50, you can see how the frequency, so the amplitude of the curve, it's way shorter, so you have a higher frequency. Well, you can sign sinusoidal curve, yeah, that's what it is. And so here you can see the higher frequency, so the shorter is the curve, means okay, you have eventually the trough is May 2026, peaks July, and then troughs again. So it's different periodicity. Sorry, oh my god. So it's a different frequency, and eventually we will see what's going to happen. Also because the dominant cycle period is 12 years rather than 18 years. Okay, so let's see the US stock market. Okay, we have the 5-year Fourier forecasts, and so I'm gonna end. Okay, so that's 5-year projection of the S&P 500, and the trough will be in June, and another trough will be in December. So by the meantime, the S&P 500 will seem to be quite stable. The market is going up steadily, and so I expect that the downdraft, the bottom of the market, will happen in between June, July, and August, notably with another downdraft in December. So that's the cyclical position. The dominant cyclical period of the S&P 500, it's almost 25 years. These are very long cyclical up or down. Dow Jones, okay, the Dow 30 is going to trough again in August 2026. Sorry, that's the June, and then it's going to bounce back and then go back down again in the same cyclical position. So for 2026, it's possible to have to expect a correction happening in Q2 and Q3. There can be many reasons, which is pure speculation. It can be the economy does not grow very fast, so disappointing macroeconomic data, geopolitical instability, the earnings of companies, they start to be shaky, or they come in not so good as expected, and then compiling on all of that, it starts to come up that this artificial intelligence, a speculative bubble, you have these sorts of bad investments, and so there are all the ingredients for the investment, the speculative part of the market to sell overpriced assets. Nasdaq Composite, okay, same, it is exactly the same. The bottom will be June 2026, or between June and July, but it indicates that there is a small bounce up and then another bottom in January 2027. So it indicates to me of a correction that will last to the first quarter of 2027, which is way up in the future, but then Nasdaq 100, okay, bottom June, and then January, and then August 2027, a rally in December 2027, a trough, which is typical, the first quarter of 2028, and then peaking 2028, September. I have to update my models. Dominant cyclical period 24.9, so 25 years. Very long cyclicality on markets. Russell 2000, again, same. Okay. Russell 3000, same dynamic. Exactly the same. Russell 1000, exactly the same. This is going to have a correction. IUJ, it's in April, so it's going to be a anticipating signal. July, S&P 500, okay, 50, which is a different S&P 500. Okay. For the volatility index, you can see here how there will be the cyclical position of the volatility index will have a bottom in September 2028, and then the cyclical trend is going to spike a lot, skyrocket very high between 2029 and 2030. This is really concerning to me. It's very, very concerning. Okay, it's going to peak August 2029, trough January 2030. That's way far in the future, but okay. So I'll thank you all for tuning in, and yes, if you want to watch this video again, it will be available on my channel, and my channel is Econometrics. Subscribe, you are very welcome. If you have any question, you can drop me an email, leave a comment, just thumbs up, put a like if you can, and I will see you next time in the next content. Thank you very much. Have a good day.